We all know as traders and investors that September is the most volatile month of the year, but what you might not be aware of is how important 2024 really is. Yes, the structure of what the market does over the next month is going to really tell us whether we're in a recession or things are actually still on the improve and we're climbing the wall of worry. And some of the big gap fills and synchronizations of the markets over the last week will have you surprised. We also need to take a look at some of the big breakouts of the markets because dark pool liquidity is happening and it's going into stocks that you might not be aware of. Let's cover stocks, commodities, and cryptos in detail right now to find out what Wall Street's sneaky next move may be. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll be taking a look at everything from the macro to the lead indicators and the hottest charts. If it's your first time here, welcome to the community. Subscribe and smash that like button if you love markets like we do. We cover them here daily. So I thought I'd quickly just start off with a very important quote. Time is the only currency you spend without knowing your balance. Use it wisely. When it comes to trading and investing, it's one of the only games where time in front of the screen doesn't necessarily mean success. So remember, set the alerts, practice the abundance mindset that we talk about a lot on the channel, and be patient. Temperament is the number one thing that will make or break you as an investor or trader. So let's talk about the data for the week ahead. We all know it comes down to two things, CPI and PPI, when you're talking about massive news events. And it looks like Bank of America, Goldman Sachs, and everybody else are coming through with around 0.2% as the estimate for inflation. So you basically say it's keeping stagnant for now on the previous read. Still there, but not necessarily beaten just yet. Now, why did we see a market bounce over the last 24 hours? Well, a lot of it can come back to this chart. We talked about it before, and that is that the put-call ratio was starting to spike up as of last Friday. Similar periods that we saw this happen in were, of course, the August sell-off. And it leads into saying, did we see synchronization of the market? We'll go through the charts later on today so you can see how every one of these markets was hitting a critical level all at the same time and why we start to see that buy the dip. But it's still to be determined whether we see swing trading and therefore momentum to realistically shift to the upside. The bears are still in control when it comes to the gamma situation. So before we go into some more data that really shows you why this market is so important over the next month, I just want to mention something I talked about in a speech recently that I did up in Sydney, Australia. And it was talking about volume profiles on the futures market. Foreign investment is up big time in the US markets, and it now equates for 17% of the total equity overall. This basically means that tons of transactions are going through the futures markets, and you must consider the overall structure when doing your analysis. A very important point and a great question that was brought up actually by one of the viewers out there, so thank you very much. US bankruptcy filings. Let's talk about the good, the bad, and the ugly. US bankruptcy filings by some data statistics are showing an increase. By others, they're showing a decrease. This is a very important factor. When you're trying to break down data, you've really got to make sure that you look through all of the rulings out there. And this becomes very important when you're breaking down everything. Of course, there is a bull case, there is a bear case, and somewhere in the middle is probably the reality. We try to do this on the channel, and of course, I spend a long time, somewheres upwards of 6 hours a day, doing research to find the correct charts. Believe me, I look at thousands of these things, and we bring in some of the best ones here on the channel. Speaking of decent indications of late market cycles, have a look here at Goldman Sachs Bull Bear Market Indicator, starting to top in at things that we saw since 2000, 2005, 6, 7, obviously hanging around that point, and just before 2020 as well. Now, when you're up here, you're in what we call late cycle investing, and this makes sense when you look at valuation metrics as well. According to Goldman Sachs, the S&P 500 is now trading at the 92nd percentile overall, and the S&P 493 is at the 84th. So basically, we are pretty expensive right now. We are getting up there, and of course, we're starting to see records broken, even with the pullback that we've had recently. Not news to any of you, but here is another representation. Now, it's an interesting chart here because if we go to Peter Lynch's quote, a quick way to tell if a stock is overpriced is to compare the price line to the earnings line. And this is a quote from Peter Lynch. Now, I think it's really important that you look at this chart. Now, you might say, well, that means the markets are overpriced. But just remember, in general, the markets remain overpriced for a significant period of time. And really coming out of a crash is when you're going to get this really good valuation on the US markets. So if we ever see a crash again and you're underneath this EPS, maybe start to think, well, this could be a good time for my 5, 10, maybe even 20-year hold. For now, though, S&P 500 earning estimates do continue to increase. We've been talking about this on the channel for a while. And whether you're looking at Morgan Stanley's data, Goldman Sachs data, JP Morgan's data, or any of these big investment and economic houses, effectively, these guys are all increasing their overall expectations, especially when it comes to earnings from the 493 stocks and, of course, anything in the Russell 2000. Now, this will become important because the next earnings seasons, each and every one of them, will be so big to whether we're in late cycle and it's the end, or whether we're in late cycle and we're going to continue to climb the wall of worry. And at the moment, this screen actually shows you a lot of very interesting statistics. First up, have a look at what Goldman Sachs are positioning into. We've been talking a long time about utilities. They've started to pick up healthcare recently and go heavily overweight into it. And of course, they've been holding their infotech and even consumer staples. That is 1, 2, and 3 incredibly defensive sectors in their overweight holdings. And have a look at the price action here when you look at those sectors. Healthcare doesn't exactly look like a negative chart. Utilities obviously looks very positive. And then we look at something like consumer staples, which has also been breaking out. 3 defensives, which they've been kind of looking at across the board, and infotech meanwhile struggling, even though they are holding it. So what this tells us is that we're seeing a kind of recommendation to people that seems to be late cycle investing along with buying into the current bubble market. And the current bubble market is, of course, considered to be the AI staples, Nvidia, and anything to do with AI in general, big Magnificent Seven style stocks. Here's another interesting factor that may have an impact on, of course, the election and how you look at the markets after the election. Remember, we actually have the belief, and it's statistical fact, that if you get a red mini win or a blue mini win, it doesn't really make too much to the markets. It's the waves that make the big difference. A huge win by the Democrats or Republicans will make a big change to the markets. However, starting to predict a portfolio based on who you think would win, well, that's probably pretty clear to gambling. Either way, if we do end up seeing a higher tax rate at 28%, this is the expected EPS hit on stocks. Notice again that we don't seem to see much hit on the utility side. So this is pretty important when you're considering that we love utilities at the moment. Of course, it's late cycle. Either way, it's kind of like a hedge if that does happen. Speaking of a couple of other things before we get into structure, iron ore has extended the route across the board. We're continuing to see iron ore drop and drop and drop. And of course, this is a negative for China. When we see iron ore turn around, that will be a great precursor that China is in recovery and things are looking better. We've been talking a lot about HSI. It's been holding up okay. It's pulled back to the 61.8 fib, which we'll go into in a moment. But overall, if you're going to see China recover, iron ore is heavily linked to it. My expectation is October, November will be quite strong for iron ore. We haven't seen any turnarounds yet. So let's talk about interest rate cuts. We know that most people are now expecting ridiculous amounts of cuts. 50 basis points has become the new expectation. I don't believe they're going to do 50 basis points. We don't know whether they will or not. But here's what happens when it comes to the interest rate cut. Usually, the first 5 days, the first 10 days, coin flip at best. Maybe even negative when it comes to previous times in the markets. But when you start tracking out 21 days, 63 days, all the way into 252 days, such as Grant has done here, you start to get a bit of a different story. And then we have to consider whether we're getting a fast cycle cut or a slow cycle cut. 25 basis points would be considered a slow cut. 50 basis points would be considered a fast cut. And generally, the Federal Reserve, when it does a fast cut, there's something a little bit broken in the system. Now, they have done fast cutting cycles before where markets have still resumed into the upward trend. It's not unheard of. But it looks like to me that we're probably following one of the two paths, such as 2019, where we kind of semi-aggressively started to cut, or we're following the 1998 kind of period. Both of these make the most amount of sense to where we are in terms of the cycle, being late, the fact that we're still seeing sluggish economic growth, although it is quite weak, And overall, we're in a bubble such as 1998, that time driven by the dot-com, this time driven by AI. Now, why will this become important? Well, it's not that we're just seeing the interest rate cuts, we're also seeing an uninversion of the yield curve. This is considered the number one indicator when it comes to calling a recession. And a lot of people are going to say this is broken because it's my belief anyway that we're going to be uninverting here on the yield curve and that we're going to see market structure continue to be relatively strong. Now, that of course could change. And as you'll see here, the first 2 to 3 months in particular will show us a lot about structure. Similar to that previous chart, this will be a very important factor. Will we go to the upside, such as what we've seen in many of the runs before, or are the Fed panicking because something's completely broken and we can't climb the wall of worry? This is why we'll need to look at structure, and we'll also need to be paying attention to inflation numbers. Because when we overlay the 1970s all the way to the 2020s, what you'll notice is it's exactly the same path. So will we see reinflation and, more importantly, a stagflation after that into an absolute bazooka? Now, I don't think it'll go as crazy as it did in the 70s, but this is something to keep in mind because, of course, when you look at the US equity markets versus commodities, we're starting to get upwards of that trend line again, similar to what we saw in January 2020, where we had that big boost in commodities after that event and we went into inflation. This could be something that starts to rear its ugly head in 2025 again. Obviously, iron ore's falling off, oil's getting tanked, copper's starting to see some recovery, but overall, we're still in a commodities down slump. So if that turns, it could also be a sign that the market is expecting inflation to actually rear its ugly head again. And based on that chart from the 1970s to now, in terms of how we're overlaid, it certainly could happen. Now, why could we see reinflation? Well, a lot of it has to do with global liquidity. The Federal Reserve is rate cutting. Every other central bank around the world wants to rate cut. Governments are stimulating the economy, and they're doing everything they can to stop us going into recession. Now, if this continues, of course, ultimately they'll stuff it up and we will enter recession. But remember, the global liquidity is increasing, and that could lead into some manufacturing stuff as well. There's actually a post over on X that I did, and it's got to do with manufacturing actually seeing inventories fall off and now potentially seeing a very good increase potential here in the future. So again, this is the wall of worry stage in markets, and it's really hard often to be bullish when the markets look so scary and the data in particular looks so scary. Remember, follow the structure, follow the price action, be patient, and find where the flows are turning. So let's talk about flows because, of course, we mentioned this one on the Friday close, and that was that I thought, and a lot of you out there did think, that large investors had started to buy the dip. We can see it here represented on Nvidia, arguably one of the hottest stocks in the world. And you can see here that there were a lot of transactions around 105, 106, and there were a lot of transactions around 102 into the close. Now, these dark pool transactions, if we're able to get past 110 in particular, kind of signify that, yes, they are buy the dippers. Someone's buying up, someone's buying that dip, and they're getting pretty excited about it. Some other notable large transactions we've started to see on the markets, PLTR in particular, Palantir, of course, and Dell getting included in the S&P, running a very, very large trade. And it looks like, again, big traders have been the ones winning on this because you can see here someone was buying big in PLTR. We have been bullish on this stock recently, and then they've got a bit of a payout. Now, they may have just closed at a profit. I tend to think we're getting towards $35, and that's going to be where we might see some temp resistance. But you must remember the trend is still up. That being said, someone transacted over the last 24 hours, and you would have to think they're most likely taking a little bit of profit. Some other large trades that have come through, the S&P 500 bear fund here, a big dark pool transaction. Could it be a profit being closed? This was Friday afternoon, so right onto the close itself. And you'll notice from this point, of course, the markets have actually regained a little bit. Now, it may be that it was a short. I'm not so sure about that, but a large transaction did come through, and we'll have to see the price action that comes with it. And as we mentioned, Google. Now, Google's facing an antitrust at the moment. We know that is incredibly negative towards the stock, but we did see a monster transaction right into the close here on Google. Sitting at 150, previous role reversal, the highs of back in 2024 early has now potentially become a support zone. If we get good price action off this level, obviously if we manage to regain some of these highs over here, it could be a good sign that Google's going up. But I think I would caution against Google, even though it's one of my 3 pillar stocks. Antitrust sucks. We've done some thinking about this. And to me, it's not a good sign for, wanting to put your equity into something that's going to give you good momentum. Maybe we'll see a buy here, but even if it rallies back up to like 165, 175, even 180, I would see that still, I think sellers will come in based on people I've been discussing this particularly with in the industry. Let's move over to the S&P now and look at the actual trade. An inside candle overall, we gapped up, we held. It wasn't too bad. So if we have a look at the 2 hour here, you'll notice we did gap up. We kind of held in between the Friday trade. Not super bullish, not super bearish. Let's take a look at the futures market action. One of the best signs here was that we broke through this early. And as I mentioned in our live stream that we do every Monday publicly, we talk about the idea of breaking through this. Actually, in my macro, we saw the NASDAQ beginning the bull run. As soon as it broke through that high, by the time it actually hit into the futures market, the real market open, it had already made a huge move. But there was actually a few good signs in the early market trade, and I'm sure a few of you got that. Overall, we did break through the 2 hour 20 moving average on the way down. I think that's significant towards the bulls. For a really big turnaround, though, we're going to need to get past 55.50. You'll see why in a moment. And 55.25 remains a very key resistance. Around this level, the most trades have gone through. It's what we shorted off from non-farm payrolls. So we know that gaining above that price is going to get the bulls back in control, a positive gamma style situation. We're still in what we call negative gamma. So there is a chance that, of course, bears will try to pressure this down, and then we may actually see, of course, new lows. It's possible, though there were some positive signs over the last 24 hours that pullbacks may be met by bull demand. Let's have a look at the strike rates now. 54.75 over the next 24 hours is the major put wall, and 55.25 is the call wall. Now, remember, we talked about 55.50. Now, why is that? Well, if we think about it, the next session, that is the Wednesday session for CPI, have a look how many puts are sitting around 54.60, 54.50. This kind of shows you that, yes, if the CPI comes out, the market chooses to go unfavorable, it could be a waterfall effect. Huge negative gamma flow, maybe a new low. I mean, that's realistically what could happen here. Remember, with options, they start to feed upon themselves, especially when you're in a strong negative gamma or positive gamma style situation. But if we get through 55.50, we flip the switch and things start to go positive again. And when you consider the 20th of September, which I believe is the OPEX here, have a look at all the puts. Now, this is what we're talking about when we call the put-call ratio. People have been stacking puts for September early, and there's 5300s, there's 5400s, in particular heavy strikes, and 5500s. And really, all of this acts as a wall that, if broken, continues, of course, on the way downside, and it starts to chunk into those key levels. So definitely worth putting them on your charts. But if it holds, it acts as a very good structural support. So when you overlay your TA, like we do here on the channel, and you overlay key levels, once you break through, you can see how the markets move from one equilibrium point to the next equilibrium point. Effectively, there is a flow going on that continues through to those next runs. We've seen that recently in Tesla just last week, where Tesla broke to the upside, blitzed its way into the resistance, and then, of course, sold off from that point. Let's talk NASDAQ. I did do just NASDAQ CTAs. The S&P looks the exact same, though. We saw a pullback. Again, CTAs are underinvested in the market right now, so I would like to think that CTAs will uptick over the next 24 hours based on what we just saw there on Monday, because remember, these are delayed by at least 1 to 2 sessions, and I'm thinking they're actually starting to buy the dip. At least that's what the current evidence is showing me. Let's move over to the other popular stocks. Tesla, you can see how quickly we can move into positive gamma in this style situation. It has a lot of calls. There are a lot of calls for September. And we know that if the markets do manage to get through to the upside here, then we are effectively going to start seeing a feeding effect. 200 and 210 are where the put walls are. So this is basically the support levels and structure. And above really 220, we start to feed to the upside. So there are a lot more bulls in Tesla than there were just a few weeks ago. And this is why the stock is holding on even through this sell-off. Let's move over to Nvidia. 110 is the major call wall here. We're sitting at 106. And we know that 110 is also the technical level. So again, no surprises. It's just funny how the options sit on these levels. Let's move over to the yield. Now, of course, an inversion of the yield curve we know is historically a recession signal. We have seen it. I'd say it's official. I don't think that you can say that it didn't uninvert now. You might be able to say the 5th of August didn't happen, but this one here is a full close underneath 1%. So that shows you that the Fed is going to cut, that we're in kind of like a timer now, and we're firmly inside of late cycle. Now, how do we know we're in late cycle? Well, as I mentioned before, utilities and healthcare are starting to improve. Utilities has actually been beating the SPY since we've talked about it since February of this year. But interestingly, healthcare only started up in July. So we're now faced in the 3rd month of healthcare beating the SPY overall. And again, this is normal. Healthcare tends to come in a little bit later here. It's definitely a late cycle style sector. It's been struggling for a while, and it looks like it might benefit as well from rate cuts. So this is going to be one that we'll need to watch moving forward. Home builders also still holding up in a series of higher highs and higher lows for now. Of course, we're monitoring that along with financials. Let's now talk about the major markets. First up, US dollar pressing the daily 20. We know this is where resistance is. It actually looks more bullish than bearish over the last 24 hours. Some good trades up until this range here of 101.58. I would be looking for potential weakness around here. There is a chance that a weakness trade may come in, but at the moment, we haven't seen any flows come to the negative side. At least look for a 101.41 close below. If that happens, maybe the sellers come back in. For now, though, I'd say the buyers actually are stronger in the dollar on the smaller timeframes. And if that daily close happens, well, it could have a little bit more of a resumption of bullish trend. A lot of people asking about oil. Is it time to buy? Do we buy this dip? Well, I guess if you're somebody that wants to position, you could do worse in terms of overall price. This is historically a pretty good point. You can see here in 21, multiple times 23, and even into the back of 23, we saw buying around this pressure. It's obviously a really good demand zone. The question is it oversold? Now, of course, by many of my indicators, it is heavily oversold, but that doesn't mean it can't drop further. And I think when you're looking at this, you have to have patience in general. Some people will scale in and they'll say, well, I want to take a little bit of a nibble and I'll buy more on confirmation of the upside. But you need to remember it's still in a series of lower lows and lower highs. If that changes, we'll update you guys. Copper has improved a little bit, some decent signs here on the small time frames. Of course, we want to see it through 428 in terms of getting, real strength in it from the swing trade. But I think that things are improving. And if we do see 4.17 taken over the next 24 hours, that would probably signal the market, or at least copper could fly up. I do feel like this is going to be a post-CPI movement, though. So iron ore, copper, many other metals, we'll be watching them very closely post-CPI. And to see what the market's doing. I don't care about the result. I want to know how the market reacts, though, because the market may be setting up a trap here to take all of these heavily sold off commodities and start to pump them back up. Because remember, October, November does tend to be stronger for those. We'll see whether that happens or whether it's not to be just yet. Let's move over to gold. Now, gold in the higher time frames, such as the daily, still in a bullish trend, obviously consolidating. It's what we call a pullback in time. Is it oversold? Well, actually, it's starting to sell off pretty heavily from the CTAs, yet not dropping. We know the main case here for gold is that central bankers from some of the biggest BRICS countries in the world, they're buying it big time. They have been for 2 years. In particular, we saw a very strong sign of them buying it in 2024. And as long as that holds up, gold's going to do pretty well. And so far, it's certainly doing quite nicely. Breakout of 25.30 will be the key for the bulls to get back in control. And remember, the longer it coils, whether it breaks to the down or the upside, the bigger the move tends to be. We're going to continue to watch that. Silver also did bounce. This was a nice move over the last 24 hours. I do like silver here. I think it's still fairly strong. CTAs, again, they are dumping it, so they're totally against that. I'd love to see it reclaim 29.20. And at the moment, I'd say there's more buyers than sellers on silver on the shorter timeframes. Tesla. Now, this is the one that everyone's looking at, 216. We fell to 210. We created an inside. You'll notice that overall, this was a very important support to hold. 210, 200, that's where the massive puts are. So yeah, I'd like to see Tesla start to regain, get through 220, start to like feed on itself with that positive gamma event. Let's see whether it can get back in there. What about Nvidia? Well, as we suspected, dark pool traders came in. It looks like someone was trying to buy the dip, but 110 remains the key resistance. And when we look at the smaller timeframes, you'll notice this is where we need to break that high structure. We do that, we're starting to put in the V. And as we often say, it's better to probably buy the V, that is the momentum, than buying the dip. For somebody that likes Nvidia though and likes this price, you couldn't really go too wrong whether it's 106 or 102 from a perspective of having a go at this chart, because of course we know it's a 61.8 pullback to a 75 pullback, and this is kind of what you call deep pullbacks for the rally that we saw. Now, if you believe in that rally, then this is the type of pullback that most people really like to take a nibble at. Let's move over now to China and the major indices. So first up, China pulling back to the 61.8 fib. Decent little bounce here off the 61.8 fib so far. I'd like to see an island reversal, maybe sit here for a few days, then bounce up. We'll see whether that happens. Iron ore must turn. So maybe inflation figures out of the US could help this market here. Oz 200 doing a lot better. Banks in particular absolutely flying in the Australian market. Just shows you there are different markets out there. We've seen a very strong previous session here. So very strong previous session. I still think the Australian market is primed to go to like 8,800, maybe even 9,000 over the next 12 months. This market's late cycle all over. It's got all of those kind of strange businesses in it that tend to do well in that period. And remember, it's underperformed for a long time as well. US 2K, much weaker. So I still think the Russell 2000 will do well, but there's not a great price action structure here. We did see, though, a confluence of many markets hitting key levels. The Qs, the NASDAQ, hit the gap fills. The US 2K hit that major level around that 2080, 2075. This is a key zone here for these markets. And of course, as we saw, the NASDAQ has bounced off the 61.8 fib. Now, what will it need to do to really get the momentum on its side? Well, it's going to need to break 19,111. That's going to be a key point there. On the Qs, just so you guys have the numbers, you'll be looking for a 465 breakout. But just remember, this was super negative. It came in, rejection, sold off, freaked everybody out, hit the second gap fill, saw some big dark pool transactions. We've got a little bit of an inside day candle here. If we start to see a market regain above 465, that will break the daily 20 on the upside, strong. That will also break a couple of anchored VWAPs. And of course, it will take out the major structure. So that's what you're looking for if you're a bull. If you're a bear, you want new lows. And of course, continuation of the trend towards the downside. Probably next target would be about 439. If you had to ask me, I do still think that it's more weighted towards pullbacks being met by bull demand based on the data and based on the stats that we've seen so far. Do remember that the big thing about coming into a rate cut is kangaroo style markets, and then the month after often remaining kangaroo, then making the decision. Recession path of the next 12 months or non-recession path. What a time to be in these markets. Let's move over to crypto. Some good signs from crypto for once. It actually broke the downward trend line. 54K held. Now, I personally think 54K was a pretty big hold. That was a big deal for Bitcoin. It also managed to break through its downward trajectory trend lines. Is this out of the woods yet? No, it's probably going to need to get above 60,000 to 61.5, but it's a first good sign. Remember, crypto, bad Septembers, just like the market. But guess what? October, I posted this over on our X account as well, following the links in the description down below. A massive, and I mean absolutely massive, overall bull run, generally in October. October is the month that often crypto starts to find its legs. So what does this come down to? Well, CPI is, of course, the big one. We'll have the game plan based on some of the banks' readouts based on tomorrow. So make sure to look out for the Tuesday close video. We know that this is the big deal. 0.2% is the expectation. And realistically, it just creates an excuse for liquidity. Don't look into it too much. Instead, follow the price action. rather than the narratives. So if you enjoyed today's video, please remember to subscribe, check out our links in the description down below, and of course, follow us on the socials, sign up for our stuff, and we will see you in the next one. Bye for now, guys. Have a great day.